This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, February the 24th, 2016. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing here this morning. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates regional economic developments. Therefore, the slides this morning will focus on our other three report areas of the GMTP report, the global risk, global macro, and U.S. economic developments. As I often do, I'd like to tie them together into a discussion on what we might soon expect from the central bankers, and specifically the Federal Reserve. In this regard, I'd like to discuss the following. Where we are in the global economic cycle and the various positioning, and I'm talking about globally here. Central bank intervention, what their track record has been, and what we might expect going forward. The growing list of risk areas that have been steadily increasing, with none being actually taken off the list, and whether we're in a recession right now, whether the United States or, for that matter, globally. It is important not to lose perspective from all the economic data coming at us about where we likely are within the economic cycle. History has shown that economies follow various cycles which have tremendous influence on asset valuations and market pricing. The global economic cycle may be more important today than ever before as sovereign economies become increasingly interdependent. We see in this chart by Bank of America Merrill Lynch's Global Fund Manager survey that it is felt that the mid-cycle has turned down hard, but the late cycle hasn't turned yet. These surveys, by their nature, are delayed, as often is the sentiment supporting them, which lags. I suspect the late cycle has already turned down hard, as illustrated by a turn in the credit cycle, which we have discussed in previous reports. One look at global trade data and the Baltic Dry Shipping Index will confirm this even for the most skeptical. We have also shown these in previous reports. The United States, until recently, has been the perceived beacon of economic growth when compared to other economic regions. This is now being called into question by many mainstream analysts. I suppose better late than never, but it is more about the data becoming so overwhelmingly blatant that even the Fed's FOMC is raising it as an issue. The Federal Reserve watches very closely the Cleveland Fed's Financial Stress Index. It shows stress to be significant, and this is critically important, especially at levels that have previously forced the Federal Reserve to take significant policy actions. These levels launched two highly controversial initiatives in quantitative easing, one and Operation Twist previously. This macro map, which I developed, is an easy way to visualize the sequential nature of cycles. The credit cycle leads the business cycle, which leads the rate cycle. The Federal Reserve always follows. And let me repeat that. The Federal Reserve always follows. It never leads. In fact, the Federal Reserve can be counted on to follow the actions of the money center banks, the owners of the Federal Reserve. We already have evidence of leveraged contracts like CLOs falling and failing in many cases, distressed debt rising, stocks weakening, down 20 to 25% globally, and recession warnings entering the lexicon, the business cycle has likely turned. These are multi-year events, not quarterly events or tradable short-term events. They're long-term trend reversals. Never forget that one of the most important responsibilities of the Federal Reserve, in concert with the U.S. Treasury, is to ensure the U.S. government operations are funded. As a consequence, U.S. Treasury yields and bond auctions are very important to them. This diagram shows the relative price performance of global financial assets to those U.S. Treasuries. And watch closely this chart. As is clearly illustrated here, the Federal Reserve has a history of taking actions when U.S. Treasuries require any kind of assistance. The fact the Federal Reserve was boxed into a corner and recently had to follow through on its directional statement to increase the Fed funds rate must not be construed that the Federal Reserve will necessarily follow through on its stated gradual move upwards to the 1.5% in the Fed funds rate. As more and more central bank analysts start to see the recessionary signals, which we've been pointing out for some time now, you can expect the Fed to reverse course. I've long maintained that the U.S. 10-year U.S. Treasury will trade at 1% by the end of 2016. Time will tell, but the trend line is becoming quite clear. The U.S. government is incapable of financing itself or rolling over the outstanding debt it has if rates were to rise. 1.5% is the maximum possible, but this will not be achieved because the credit and business cycles have already turned. A turn in the rate cycle, if we can even call it that, is ahead. We're going to see new central bank initiatives in 2016 that will shock even the most cynical person out there. The central bankers are trapped. Even during equity bear markets that were not caused by a recession, the Fed has typically responded with policy easing. So here we have strong indications of a U.S. recession and stocks looking at bear market threshold levels. We should expect something very soon. Unfortunately, it must also be noted that the Fed tightening cycle has a history of causing events out of nowhere and shocking the markets. It is my opinion that history is not going to be kind to Fed Chairperson Yellen for raising rates, even as minor as they were, as events unfold in 2016, 2017. It may go down as a monumental monetary blunder which triggered events when, in fact, she should have been dramatically increasing liquidity and credit. I'm not saying it's her fault. It's how history is probably going to perceive her recent actions. We talked extensively in the last few Matter reports about the pressures corporate earnings are under. You can expect this dated 12-month forward earnings per share estimates to soon fall significantly. What is more important is that we are already at levels that later the NBER determines that we were already in a recession. Alarms must certainly be going off at 33 Liberty Street in New York and fire jackets being quickly donned. If the central bankers don't act soon, the fires may soon get totally out of control. For months, we've been watching the carnage in the high-yield debt market, but now we see the CLOs, that is, collateralized loan obligations, down to levels signaling near panic. Remember CDOs? That is, collateralized debt obligations at the center of the 2008 crisis and the shadow banking problems? Well, there's not much difference between CDOs and CLOs, actually. It is time for another ECB Chairman Draghi's whatever it takes speech. The question is, will anybody be listening this time? The big money is already betting NIRP, that is, negative interest rate policy, is in the U.S. future. It is already a reality in the ECB, Switzerland, Sweden, Denmark, and Japan, and so it's only a matter of time before it washes ashore here in the United States. I've done a lot of work at the Financial Repression Authority, which I'm a co-founder of, to determine where the central banks are headed. It has been my documented view we will see NIRP, OMF, that stands for overt monetary financing, or more commonly helicopter money, and new rounds of quantitative easing in the not-too-distant future. 3 years ago, I predicted an M-top where the inside strength of the M would be reversed due to unprecedented central bank policies which would trigger the beginning of a potential Minsky melt-up. Here is that chart updated as we go to press. I'm not sure if we get a higher high or a double top or a 61.8% Fibonacci retracement from the lows. What I do believe is we are near the point where the central banks will soon take action to trigger the melt-up on the right side of the M-top. I ask you, what would happen to stocks if the Federal Reserve said it was going to start buying equities like the Bank of Japan has done with the Nikkei and other central banks are doing? It is reported that governments and their central banks have already purchased over $29 trillion in public assets. Would that cause a melt-up? At least temporarily, while the currency used to purchase the assets is perceived to be of some value. I'm not saying that's what they're going to do. I'm just showing you the magnitude of some central bank actions and what they could have on the market and why I expect a Minsky melt-up to ensue here at some point. Let's return to U.S. Treasuries and the sales required to finance the U.S. government. China is selling, and Japan has stopped buying. These were the two biggest purchasers of U.S. Treasuries. But the problem is larger than that. Overall, foreign buying of U.S. Treasuries is falling rapidly. Emerging markets are being forced to sell currency reserves because of falling trade and large debt loads needing to be paid. Energy exporters like OPEC and non-OPEC nations have the same problem due to oil below $30 a barrel. Commodity-dependent nations also have the same problem due to a collapse in commodity prices. The Canadian dollar is down nearly 30%. It is tough to acquire U.S. Treasuries under those sorts of pressures. The most worrying to the Federal Reserve and U.S. Treasury is China. We wrote a few years ago that China was buying U.S. Treasuries through Belgium. We see we are correct, as China is now selling those same holdings. The reversal in Chinese currency reserves matches closely U.S. Treasuries being sold, and total foreign reserves being quickly depleted. For those trying to figure out what this means to the market, this chart may help. Global equity values follow closely growth or decline in global foreign currency reserves. Is anything going to change any of this? Japan has been at quantitative easing and QQE and now NIRP for a couple of decades now, and things are only getting worse in Japan. Exports continue to fall, even after debasing the currency to an unprecedented degree to give them a competitive advantage without any results to show for it. Imports are falling, which, like China, takes many dependent nations down with them in Southeast Asia. Japanese economic risks, mounting geopolitical risks associated with a Chinese hard landing, energy and commodity risks, emerging market risks, monetary policy risks, and the list goes on, are not really new. They have been on most investors' watch lists for some time now. Unfortunately, they're not going away, being resolved, and are only getting worse. Now we find new risks being added, specifically a potential U.S. recession and a EU banking problem. Yes, yet again, European banks, leveraged at north of 55 to 1, remembering that Lehman failed at 33 to 1. Investors, according to the Bank of America, Merrill Lynch's recent survey I mentioned earlier, says a Chinese recession and the emerging market debt crisis are still worrying investors and to a greater degree. Why would investors place $7 trillion in bonds with negative interest rates? Or put another way, pay someone to take their money? Other than possible currency appreciation or expecting NIRP yields to fall even lower, it is about paying for the safety of their assets. It's about the return of their capital, not the return on their capital. It's called fear. This is the fear trade. I sense that a potential U.S. recession has now really got investors' attention, and it scares them. Ignore the misleading U.S. government jobs report that the White House continuously ballyhoos and the politicians bring to the electorate. Smart investors are looking at something much easier to understand, that is, taxes withheld, for what is really going on, and it isn't pretty. They are also looking at entry versus exit trend rates from firms. It has been down for a long time now, and layoff announcements are once again increasing. The big employer gains in the U.S. for a few years now have been waiters and bartenders in what has been called by many the great waiter and bartender recovery. Of course, that's never expressed that way by Washington. Now we see that may take a major turn. Retail job cuts, which have been the bastion for employment, even if it was low-paying and part-time with no benefits, offered some level of subsistence. Now we see that robotic advancements are about to destroy this job market in Schumpeter's relentless technology wave of creative destruction. Robotics of all forms is coming to the retail sector, which Charles Hugh Smith and I have laid out in a number of macroanalytic videos. The White House now seems to agree and has just released in its annual economic report of the president figures that show that it expects 83% chance that automation will take a job with an hourly wage below $20. 31% chance will take a job with an hourly wage between $20 and $40, and just a mere 4% chance will take a job away from somebody making over $40 an hour. I think it's really telling on that grid, but 83%? The White House used the same data that underlines other research in the field of labor and robotics to arrive at the conclusion. The National Restaurant, which is the cheerleader, as far as I'm concerned, is now being forced to report drops not seen since late 2007. So much for the great waiter and bartender recovery, that's for sure. For years, drops in distillate demand was a sure sign of a recession. Why would it be different this time, other than no one wants a recession? Especially when energy prices are falling, and reduced energy costs have traditionally acted as an economic stimulus. Either something is broken, or this is going to be a very, very serious recession. In case I haven't made my point, have a look at this chart by Thomson Reuters, Credit Suisse. U.S. NIPA post-tax profits are falling at 10% year over year. They have gone negative, and trailing 12-month operating earnings per share is also about to. What are you going to believe, your lying eyes or the government? No wonder Donald Trump and Bernie Sanders are so popular. U.S. voters are voting against all of this Washington spin with their middle index finger. As Donald Trump said, do you think we would have this sort of turnout if unemployment were really 5%? Look at the crowd. It looks like closer to 40% to me. That, by the way, brought the House down, which is also telling. In closing, remember the answer will be, by the government, and it always is, to print more money. It is the only answer politicians will ever agree on, and it's coming in a much larger extent. And with it, inflation, possibly hyperinflation, and eventually a fiat currency collapse. Invest accordingly. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing, however. It requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading. Make sure you have a knowledgeable and well-informed financial investor. So until we talk again, may 2016 turn out to be an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.